Absolutely fantastic. Those of you who are here, this is great. Thank you very much. And the entire team today that's going to share VA, FHA, VA, everything you wanted to know about mortgages and anything else in life. So they are here to help you, and we have the next half hour, 40 minutes. Just hang in there, and if you need questions, chat them. Joanna is monitoring from home. She still has COVID, so everybody text her good wishes. And without further ado, I'm just going to turn it over to the three caballeros.
All right, let's do it. I'm going to start, guys. My name is Derek Gillingham. I'm obviously with D&V Mortgage as the marketing director, also a loan officer with the company. Two of the owners are here with me today, Bob Vaughn, Dan Davis. Andy Davis had a prior engagement today, so he won't be here. Not the full team, but pretty much all of us. Just a little bit about the company to start. It was started 6 years ago by 3 Fort Myers locals, and 2 years ago they brought me on to handle their marketing, also a Fort Myers local. Pretty much all the main stuff we do loan-wise. They'll get about, a little more detail about that as we go. But for anybody who needs a quick loan question, we're actually almost just right across the street. So if you guys have any questions, stop by and ask, and then I'll go ahead and start off with Bob today.
All right, so some differences here between really conventional and FHA. If you find yourself in a finance transaction today, which you're lucky enough to have that, right? But so real quick, as far as from a client's perspective, like whether you should go conventional or FHA, generally it has to do with like what your credit score is. Does it financially make more sense to do an FHA loan than does a conventional loan? The pricing as far as like if you're, let's say your credit score is below 700, traditionally it's probably made no sense to go FHA because if you're putting minimum down, as your score drops, the cost of your private mortgage insurance starts to go up a lot, right? So the interest rate in the mortgage insurance starts to get a lot more expensive on a conventional loan with a lower credit score. There's also waiting periods for adverse credit history events like bankruptcies and short sales and stuff, or maybe you would go FHA because it's shorter than conventional. But as far as now, the big picture really is like appraisal gap. I mean, that's the big thing. If you're putting 3.5% down, you're putting 5% down on a conventional versus an FHA loan. Honestly, from your perspective as a listing agent, there's really not much of a difference, right? Because it still has such price. So if someone has, 50% down payment, obviously they probably have more money to work with in the event that, the appraisal comes in short. But the big thing really for you in this market is it going to appraise, right? If you pull comps and you look at it and here the comps and there's all of a sudden there's one that's $40,000 above it, you click on it, and it's probably going to say it's a cash deal, right? So they still have to appraise. As far as the listing agent goes, that's the big difference. Anybody have any questions as far as anything going on FHA conventional right now?
Anything with age on that?
The age? No, there's like the question was, is there anything I can do with an age on a customer? And the answer is no. We can't really factor that in there. So FHA minimum down payment, right now.
Let me think it's 3.5%.
3.5%. Yeah, it's a 3.5% down. You can do a conventional loan with 3% down. Obviously, it's going to be a little bit more strict. You might not be able to get your debt to income ratio as high on the backside of that, but 3.5 and 5 for a conventional loan is kind of the down payment starting point.
Where is your business at as far as obviously more conventional probably than FHA, or is that what you're?
Oh, yeah.
Market,
Yeah, and honestly, people are scared of FHA deals.
Right.
But again, if you're putting minimum down, the reality is it still has to appraise for whatever you're buying. That's the big thing, and people are scared of it. They're more scared of an FHA loan. Just because I guess historically there's seller concessions, which does anybody know what that is? I'm just kidding. They don't exist anymore, right? But so realistically, they both sell different. There's not much of a difference as far as the appraisal goes. Sometimes they're a little bit pickier on like, is safety concerns. You got to do a head and shoulders inspection in the attic when there's an FHA loan. But really, other than that, unless it's new construction, on an FHA deal, you have to do it if it's on well and septic. You have to get a well and septic test. But there's really not much of a difference as far as it goes.
Are you closing the FHA in 30 days?
Yeah, close it, any one of those 30 days, FHA, VA, conventional. We don't do construction loans and we don't do, lot lines, but we can share accounts.
Yeah, so for FHA, it's kind of to add on that. So like as a listing agent, when you get, multiple offer situation right now, I mean, the big thing to look at is how much they're putting down. Probably more so than is it FHA or conventional, as long, at least the property is in really good shape. I mean, because honestly, FHA appraisal might be a little bit more strict as far as the appraisal goes with the inspection, but as far as the value goes, I mean, an appraiser is gonna look at comps the same way if it's FHA versus conventional. So if someone's putting 3% down conventional, you're gonna see that on the contract, as far as how much they're financing. I would look more how much they're putting down versus whether or not it's conventional or FHA, just because there really isn't that much of a difference. I mean, we're seeing that people don't want to take an FHA deal, which that's fine, but if they're gonna accept a conventional offer that is 3% down or 5% down, there's really no benefit in that from a listing agent side of things. So
Try convincing them that.
right, that's it. I mean, and that's kind of what happens. We're having a lot of people call us like, can they go conventional? And we're like, they can go conventional, but it's a disservice to them because they're not gonna get as good of a combination of interest rate and mortgage insurance, and there's really no difference. If it doesn't appraise, they're gonna have to come up with a different formula than the other. So it's more of convincing the listing agent that one deal is different than the other, but in reality, it's more based off the down payment versus the actual process of the two transactions.
On the appraisal side, I know when they do the appraisal, how many times or, well, I guess what's the percentage as far as your repairs being needed? I mean, I know that's part of it, the seller trying to think about it. I don't know if FHA needs fixing up. Have you seen them get really tough on safety issues mostly or what?
We actually have been pretty lucky. I don't have any issues. I mean, if you have a hole in the window, if you walk in and there's a huge, stain on your roof that looks like, or the ceiling where it looks like the roof's leaking, stuff like that. But as far as nitpicking for FHA versus conventional, I mean, there's not really much of a difference as far as, does this need to be fixed or not? But every trade is different.
I would say it's probably a little bit more FHA than what we've seen, but it's on older properties that have, have wood rotting. I mean, it's to what he said. I mean, a conventional loan, I mean, they can still make that subject to if the house is in really bad shape. We've seen that in the past. They probably are a little bit more strict on the FHA side. If you got a property that's well cared for, doesn't have to have upgrades. Like they're not looking at that. It's more, it's the safety, the foundation, does it have wood rotting outside, that type of stuff that they could make you repair prior to closing versus conventional. Like probably wouldn't if it's just, simple wood rot. But I mean, we haven't seen much. I'd say it's a hair strip.
And it really depends on who your appraiser is, honestly. And now in the appraisal market, there's such a, demand for appraisers out there that the appraisal management companies, like, so how we order an appraisal, us as the broker, the lender, we go through the appraisal management company who then engage appraisers, so they keep us completely away from it. Because otherwise we'd be taking the lunch. But so, and then they pick over the appraisal. So if you have, honestly, the reality is appraisers that have been in the market a long time and they're old school and have been doing this for a long time, you're probably going to have less issues with someone like that than someone that's new and nervous. If that makes sense. So it's kind of the luck of you get a lot of trust.
Yeah, I would definitely agree. The newer people in the market are definitely going to be stricter just because they haven't been through it. They probably already stricter to cover themselves, than the person that's been doing it for 30 years. So that's definitely true. So.
How many issues have we had with insurance before?
Homeowners insurance? Almost none. Yeah. I mean, you can pretty much, like if you need a new roof, you can pretty much still get insurance, but you have to be able to put a new roof on it, close it,
So we've had inspection issues, like where people back out because of inspection, but like you can pretty much get insurance if you have money after the fact. You can get insurance and then fix something down the road. So like to answer this question, yeah, we don't have it. We have insurance companies that will cover something, but we have inspection issues because if someone doesn't have money to put a roof on after closing, they're just gonna back out from the inspection versus actually being a homeowner insurance issue. Does that make sense?
Yeah.
So.
Well, I just think we have recently had a deal where this insurance popped out and we were in the midst of getting it closed and that the insurance policy didn't have like, inflation or something, so like it's just the insurance, they had to go through a third party, through the HOA. Third party to reach out to get the master HOA policy, and it was a headache. It was a nightmare basically, so,
That's probably different than actual homeowner insurance, because you're probably talking about like master insurance.
so they had to have homeowner insurance, the homeowner insurance had to, take care of whatever the master. policy
Did-
is here. And like the bylaw didn't make sense, and like the whole entire insurance was just like, I don't know, I've never had.
How does it?
Yeah, they are more fun, aren't they?
And that's more from the condo side, from.
Yeah.
I don't think it's been at, kind of at the end once it's done. But that's more the condo side, any kind of guidelines, for that versus, you have a single family, you're never gonna deal with that because you're not gonna get the master insurance policies from that. So that's kind of more condo side, I think, versus actual issues with inspection. So I'm gonna briefly go over VA. Any other questions on conventional FHA? So VA loans, another fun loan. Again, a lot of people think VA loans are a lot tougher than FHA conventional, and they're really not. Just quick overview on VA loans. VA loans, you can have as little as 0% down. Now you still have closing costs, so the veteran still has normal closing costs that they have going FHA or conventional. So if they don't have any money, either the seller would have to cover the closing costs, which in this market's probably not happening, or they're gonna have to have money saved for pay for a full year's insurance, pay for the monthly closing costs. So that's kind of that. Minimum credit score on VA is 600. Under 620, there are a little bit tougher to get the loan. They have a little bit lower debt to income. There's a few guideline changes from 620 to 600, but it's down to 600. And the VA has what's called a funding fee. If you're not disabled, if you're on disability, basically we pull the certificate of eligibility. You either have a funding fee that the VA charges for getting the VA loan, and the reason they do that, veteran gets one, they don't have mortgage insurance when they're getting the loan. So like they put 0 down, they don't have mortgage insurance, their interest rate's going to be great, and they don't have mortgage insurance. So the veteran does charge that. The VA charges the funding fee, which FHA loan has as well, but that can get a little bit pricey, but it's still by far the best deal, putting 0% down. So first use VA funding fee is it changed like a year ago, so I just want to make sure I got it right. 2.3%, and the subsequent use is 3.6%. So that just gets added to your loan amount. So it's not like you have to have that up front; just gets added to your loan amount. FHA they have a funding fee. Well, it's not called a funding fee; it's called upfront mortgage insurance of 1.75. So it's not that much different than FHA. If a veteran has a down payment, then the funding fee gets reduced. So if they have 5% down, it is 1.65. If they have 10% down, the mortgage gets reduced to, just double check, 1.4%. So, and then if they're on disability, it's 0. So if they're on disability, or best loan, no mortgage insurance, no funding fee, none of that. So
That's if there's any percent of disability.
I believe, do you know, I think it's 10%, right? 10%. So the certificate of eligibility basically says you have a funding fee or you don't. So we had once we pull the certificate of eligibility from the VA website, it basically says yes or no. So that's kind of how that works. As far as the differences from a VA loan to an FHA loan, not a lot. They are required to have a test inspection, which is one difference. The buyer is not allowed to pay for it. So basically anyone else can pay for it. Realtor can pay for it, the seller can pay for it. We can, the lender can pay for it, anyone can pay for it other than the actual veteran. So that's the first thing. Obviously, test inspection has to come back satisfactory. And then the second thing, if the house is on a well, not a well where you're watering, the plants, but if it's on a well, interior well, you have to have a water test, and that can be paid for by the buyer. So that obviously has to come back satisfactory as well. So it gets tested to the county to make sure there's nothing in the water to make it unsafe.
No
So
more septic tests.
what's that?
No more septic or tests.
No septic tests. I mean, the appraiser just has to mention in there that the septics could, put in there to code as far as the distance from everything, but that always is, honestly, like it's grandfathered in, it's been back in the day. If the appraiser, he'll put a comment in for that. So no septic test for FHA, VA, we never have to have septic tests. So it's just the water test if it's on a well, and then the pest inspection. So I mean, right now it is, I mean, we're having a lot of agents tell us that, VAs, no one's accepting VAs. I mean, honestly, the process is basically the same, like we're saying, other than, the veteran a lot of times don't have down payment. So it's, again, if it doesn't appraise, you're gonna have the same issue as FHA or conventional. If someone has, 3% down, it doesn't have. So that's the big difference. The only other difference is on the appraisals, you have to order them through the VA portal. So it doesn't go through our normal AFC. Every lender actually has to order it through the VA portal, and the VA portal, they assign an appraisal. Yeah, you are. I mean, it's honestly, we haven't had a ton of issues with VA versus everything else too. If the house is in good shape, I mean, kind of the rule of thumb, if the house is in good shape, should be fine with any of them. We've had a couple really strict VA appraisals come back in the last 6 years. I mean, probably 2 or 3 from what we've seen. That, I mean, honestly, something they shouldn't bring up, because it's like, it's $100 fixes, and it's gonna cost more for the veteran to get a re-inspection than it is to just get fixed. But it's kind of up to the appraisal, up to the appraiser whether or not he thinks it's a health and safety issue. So, any questions on VA loans or
Yeah,
anything like
you're
that?
talking about the VA appraisal. Maybe run into the tide, have you need Tidewater Act at all? No, not in today's market.
Mhm. No, we haven't had that.
Maybe, the way I understand it is about a house was appraised, the appraiser can go ahead and ask the agents what comps you have basically to support the sale price.
Oh, I mean, they do that. I mean, a lot of times we'll have FHA and conventional loans that if
Through VA, I think it's called a Tidewater.
I know you're talking about, but we've had them come in low and they didn't do that.
right. They typically, a lot of times they'll call the agents to try to see what they have, but it's, I haven't actually seen that, so.
The VA buyer is not required to put any money down.
That's
Is
correct.
that correct?
Correct. 0% down. They, like I said, they do have to pay. In the past, seller would cover closing costs. That was pretty easy back in the day, but this market, you're just not seeing sellers want to cover any closing costs, because then obviously the purchase price would go up and it's that much harder for the property.
There is one of the, that exists with the other ones, and that's like, if you already have the loan somewhere else, and you're keeping it, and you're like, because I actually just had a phone call like 3 days ago, where someone was pre-approved through, whatever lender it was, right? And they have to be a loan up north, and they want to keep the house, they want to buy another house down here to be able. You do have to calculate entitlement at that point, because you've already used some of your VA benefit. What happened was they gave them pre-approval, and later on said, hey, yeah, we can't really actually do this because you don't have enough VA entitlement to do it, which is something you need to figure out like immediately on day one, so essentially they have to be able to guarantee like 25% of the conforming loan limit or the loan amount, so you got to calculate that. If you have a client that already has a VA loan and they're keeping it, that's something mentioned to them, like, hey, just make sure your entitlement's gonna be okay.
And if they have that first VA income, you have to do primary residence for a year.
That's in, so anytime you buy an FHA, VA, you sign an occupancy affidavit at closing that says, my intent is that I'm gonna live in this, the next 12 months. And so if you ever have a deal where someone's buying a primary residence and there's a lease in place, right, and in the lease is, has like a date that's like, it's gonna be an issue that contradicts that affidavit.
And FHA and VA, they are only primary. So we've had every call now and then where I get a veteran that wants to buy a second home investment property. It says he's read something online. I don't really know exactly where they're reading it, but it does have to be primary residence for both FHA. So.
Interest rates the same on an FHA, VA versus conventional.
So FHA and VA are typically lower. I mean, actually, they're always lower. Typically, VA and FHA, with us, I'm not talking for other companies, but for us, FHA and VA rates are always lower than conventional. But then you have, the upfront funding fee on the, you have the VA funding fee on VA, and then you have the upfront mortgage insurance premium on the FHA. So it's, even though you're getting a lower rate, it's kind of a combination of rate, upfront mortgage insurance, and monthly mortgage insurance to determine whether or not conventional or FHA is, the way to go. But to answer your question, FHA, VA are not all, the rates aren't always the same. They're typically pretty close, but they're almost always better with our company than conventional. So, and the spreads kind of, they range. I mean, I would say, probably like 0.5%, not give or take. I mean, it's going to be based off credit score and different factors, but I would say it's probably about 0.5%. When you say about, yeah, roughly about how much?
But on the FHA, you gotta know that your mortgage insurance can go away, but no, I mean, it's 10%, then it goes back for years, but, so there's always that you can consider, you know, so yeah, FHA has a lower rate, but you gotta look at like, what's my rate plus mortgage insurance, like you said, plus the upfront fee versus what would be conventional. And honestly, historically, I don't know, if you're putting minimum down, I would say it's probably, a 700 to 710-ish cutoff to where like, if you're putting minimum down, if you're below that, you want to do an FHA loan. But in this market, because for whatever, listing agents don't want to accept FHA offers, people are getting basically priced into you going with the worst loan option because they're offering this much.
Any other questions on the free type of loan process? I'm gonna kind of give an overview on a couple other things. If there's no other questions on that. So the condo financing, kind of getting into some of your stuff. So there's been some changes in the last couple months that Fannie and Freddie have made because of that condo that collapsed in Miami. Basically, that's why they've done it. I don't know if you guys have run across it, but we've run across these changes and done a few loans and kind of know the ins and outs of it, because talk to our condo team and whatnot. So it's not permanent guidelines right now. It's basically Fannie and Freddie put in temporary guidelines. So every lender kind of might have a little bit different stuff that they need right now until Fannie and Freddie put in permanent guidelines. But essentially what they're trying to do is see that these condos that they're financing are in good shape. I mean, it's not an easy way to do it, but they're kind of having the lenders do it, put it in their hands how they're determining whether or not condos are in good shape. So the lenders that we use, what they've done is they've added some additional questions to the condo questionnaires that to determine, and they work with Fannie and Freddie to make sure that Fannie and Freddie were unsure of the fact. So this is how most lenders are probably doing it, because they're more hand in hand with Fannie and Freddie. So there are a few questions that have been added to the condo questionnaire for the last couple of months that are kind of open-ended questions, and that's kind of where the issues can come in. And I have them memorized, but I'll go ahead and read them all. So the first question: does the project have significant deferred maintenance? So they ask these, and typically the ones people answering the question are management companies, right? So they're, typically they don't want to answer these questions because, right? They don't know. I mean, they don't want to get sued by someone. And honestly, this is pretty open-ended. Like, what do you consider significant deferred maintenance, right? I mean, it could be what you determine, what you say is significantly deferred versus someone else could be completely different. So what we've seen, I'll go ahead and read the four, and then I'll kind of tell you about what we've seen happen in real life. So that's the first one. Has the project received a directive from a regulatory authority or inspection agency to make repairs due to unsafe conditions? That's number two. And basically all of them, if yes, please explain. Number three, has the project failed to pass any type of regulatory inspections or recertifications? And number four, does the project have any current or planned special assessments? Right. So special assessments, that was always there. So that's not really an additional question. But the other one, really the first one, is where we've seen that these management companies don't want to answer. So they put, for our legal counsel, we're not going to answer this question. Basically, review all the budget, meeting minutes, etc., to determine whether or not there's significant deferred payments. So that's kind of what they've. I've seen this on 2 in a row. So they don't want to answer it, and it makes sense. Like they don't want to get sued. Like one of the buyer says, "Hey, right, exactly." So talk to the condo team to determine what the workaround of that is, because the place would be perfectly fine, and that should not get financing for that. So there are a couple different workarounds. One, if the HOA for condo president, vice president, whoever's on the board will answer these questions. So obviously they don't answer the condo questionnaire on every single loan because it's too much work. The management companies answer these, but if you can go back to them and have them answer that, and someone will put their neck on the line and say no to these, you're good per our lender. I mean, every lender will be a little bit different. So that's not on wood what's happened to us. We haven't had issues with it. But if they won't answer it either, then the workarounds are basically the lender has to determine whether or not they think there's significant deferred maintenance. The first thing that they've been doing is, and if it's a limited questionnaire, they didn't need any of this stuff. So before, all we needed was an appraisal and ask their pending litigation, and that was it. We didn't need a questionnaire at all on limited. So that's 25% down primary residence, 30% down second home. It's a limited review. Investment property condos always need a full review. So on limited reviews, we didn't need any of this stuff. If there was no pending litigation, the appraisal came in, we would still need master insurance, approved insurance. We wouldn't need any questionnaire. Now they're needing a questionnaire because they need these 4 questions answered. If the HOA or the condo place won't answer it, they have to get the last 6 month board meeting minutes. And where the issue comes in there, if there is any roof stuff or any issues with the property, basically they're going through these board meeting minutes. And if they're seeing any issues that people are having that show up to the board meeting, obviously they have to record the meeting minutes. There's issues with these properties. These lenders are having issues financing. So where we're seeing where there could be issues more than anything else is there's still Irma roof issue. You know, there could be someone that filed a claim with their insurance and it's still, you know, the insurance, it's not a lawsuit yet. It's still just a claim and they haven't had either got a new roof on or the insurance company hasn't determined whether or not they're getting a new roof on. So basically, if it's kind of pending a new roof and it's been pending since 2017, and no one will answer these questions now. So like if there's a new roof going on, someone can still answer that no, but lender would be fine with it. But if they won't answer it and they see in the board meeting minutes that a new roof's going on because there's leaks or whatever, then the lender kind of has to figure out, do we want to lend on this? If it's been going on since 2017, how much damage has there been from 2017 till now, you know, due to roof leaks? So I talked to our condo team and they're like, it's tough because like they can't really put their neck on the line if no one will answer this, then there's no.
But it's all subjective is what it is.
Exactly. So I mean, the lenders are covering themselves if this answer won't get, if no one will answer this question, and the board meeting minutes look like there is some deferred maintenance, rule of thumb, I feel like I have trouble with financing. So we haven't had that, but I've had a lot of listing agents that work with us that have had it and asked me about it. And their deals have fallen through. I haven't had any deals fall through from it, but the writing on the wall is if there's a new roof going on, it's in the board meeting minutes and they won't answer this question, more than likely they're not financing.
Any quote unquote hard money lenders for that kind of a scenario?
There are, I mean, Sandcap, I mean, all those places will do. This is basically warrantable, non-warrantable. If we
And
can't
can
get
you
stuff.
shop them for them and help them?
We don't do hard money loans, so I mean, we refer to the normal places that do hard money loans, so Sandcap obviously does it, I think BC Bank does it, Lake Michigan, those type of places, you're gonna be looking more at an arm, if you can't go through Fannie Freddie, you're gonna look, I think Sandcap says they're only doing like 5-1 arms, but honestly, that's their products, I don't wanna talk about that, so. But that's kind of the new condo, you know, that's the new condo guidelines to a T until they come out with the permanent guidelines, which I've been told should be sometime this next year.
So the intel about the question. If the management company is confident in their job.
Oh, they should have that, but. So, and so to answer your question, so on top of that, on top of the questionnaire, there is what's called master insurance on any condos. Basically, condo association, if there is no flood zone, they're required to cover flood insurance, they're also required to cover exterior of the building. In addition to that, the buyer has to get interior HO6 insurance. So that's kind of what they have to get separately. So if the master insurance isn't adequate, some of the stuff isn't, covered, or their flood policy isn't adequate, then the lender can require, well, if they don't have any flood, they're probably not gonna be able to get regular financing, but if they have flood, they don't have enough, then a lender can have the buyer subsidize the difference and get regular flood on, by themselves. That's probably what happened with you, something similar.
Well, the bylaw said that only certain buildings had a budget for flood, and then these other certain buildings, they had to get their own flood. And
I haven't had that.
yeah, they're really tricky. And then our building was one that was supposed to already have the flood insurance, but when they went to sign, like transfer, like apply for the HOA application. They were required to get the flood, but so they were requiring them to get it according to the HOA association. But in the bylaw, it was supposed to be covered. So they were making her pay for it, even though it was already covered. It was just a mess.
I haven't had that.
Yeah, it was like a whole mess. And then it was talking about inflation, and they had to go back and look at the insurance cost. Like, just a nightmare. Yeah, what? I'll think tomorrow. We're hoping tomorrow.
I have had where the condo association, they cover like the minimum that they have to, which Fannie Freddie will allow that. But then the buyer has to get the difference, basically, to make up the difference, and Fannie and Freddie will allow that, and they think it's so good for you. So I've had that. That can get a little tricky too, because every year the lender has to get updated policies, and It's a little bit trickier from a servicing side of things, but I've had that before where, you know, buyer has to get supplemental flood insurance because of the
Yeah,
association.
it was, I think it was a very easy situation, I guess, but I wanted to know how many issues you guys have with like insurance policies.
No.
The biggest issue is probably the budget, and, budget and, so like the budget. has to be-
And pending litigation.
Litigation.
But this is before,
Right,
but this is
right.
before these 4 questions. These 4 questions, I mean, they do open up a whole can of worms
Right,
that, I mean. And I know there's been issues, like I said, I haven't had a ton with us, but I've had a listing agent call me and ask me about this, that I know there's a lot of issues going on in the market with that. So hopefully Fannie Freddie comes out with some permanent guidelines that aren't so open-ended, because like, this is just, you know, a management company can kill a deal just because they don't want to answer these questions. But on the budget, one thing on that, so as far as budget goes, so people always say, oh, this building or this association doesn't have reserves. Well, it's not so much that the actual built reserves that the lender's looking for, and they're probably looking for that if there's other issues with like new 4 questions. But what they're actually looking for is they're looking at reserve allocation. So does their right, exactly. So like if someone has no reserves, but they're putting away 10%, they're allocating 10% of their budget. It really, I mean, that means guidelines, which is kind of crazy. If someone has a ton of reserves and they lower the reserve allocation to, let's say, 2%, because they have so much saved. I mean, I would think that they should be able to get financing versus the other way around, but the guidelines state it's the reserve allocation to the budget. So it's 10, which is 10%. So.
You have an issue with the only way around it is really limited on their review.
Right.
If you was talking about, so if you buy a primary residence, you have to put 25% down. Or a second home, you have to put 30% down if there's a budget issue. Which is something you should look for, like you can have whatever lender you're using, that's something they should ask for immediately and look at immediately, because it literally, you just look at it and like, okay, we're good, you know, it's something you can just check like that, you know.
Yeah, with these new questions, the only, like I said, the only tricky thing there is if anything comes back and they don't answer these questions, then the budget could, you know, then they're gonna ask for meeting minutes and possibly budget, because they want to see financials and all that type of stuff. So then it could get brought up at that point. So like things have changed in the last couple of months because of that. Like even on limited reviews, you kind of have to figure their forward now in case these questions won't get answered, you know. So that's kind of the way I'm handling it. And after my last one, which again, not gonna wood, everything went fine. I mean, I'm gonna keep listing agent, buyer's agent kind of posted that these are new questions that Fannie Freddie want answered. If they can't get answered, these are the workarounds. So start having the agents work on getting the last 6 months board meeting minutes to kind of, you know, then we'll have them ready in case the association won't answer these questions, or the president, vice president, you know, secretary, whatever, won't answer them as well. So then they'll have board meeting minutes. I can already have those 6 months reviewed, make sure that there is no, you know, deferred maintenance stuff, bad roofs in the board meeting minutes in case those can't get answered. So it shouldn't slow the deal up if we have those and everything goes good meeting minutes. So moving forward, that's kind of what we've said we're going to do. This is all kind of new, so it's, you know, it's subject to change once as Fannie and Freddie change it. It's going to, you know, we'll obviously adjust as well. So.
Can you guys talk about the approval process on just that, and how do you go about that?
It depends, are they self-employed or not, you know, self-employed people don't want time. And if someone's just like a W-2 employee with stable work history, you know, good credit, I mean, 25 minutes. You know, like, it's just, you do it enough to where like if you're talking to someone and all of a sudden you're like, I don't think this person knows what they're talking about. Like, yeah, I'm probably gonna go, okay, I need to see your pay stubs, I need to see this. But like if you're talking to someone, it's like, hey, I'm a teacher, I'm making $5,000 a year, I've been doing it for 10 years, you got 800 credit score, and have, you know, and then know like, hey, I got like $60,000 in the bank, like I'm not gonna, I'm not gonna beat you up, you know what I mean? Like I'm like, okay, good, you know, but like if you're self-employed, we're gonna want to see your, you know, it's a bigger pain now, you know, the last 2 years tax returns. So like right now would be probably the worst. We would need, you know, your last 2 years returns, a full profit and loss for this year, your last 3 months of business bank statements. That's everybody, you know, so just get ready for a roller coaster ride. So.
Would you do that first before they go out? And look
Oh,
at properties? So when
100%,
they walk out, they're going, okay, all we need now is
Yeah,
just. the
we're not
property.
writing a letter for self-employed borrower unless we have all their stuff.
Okay, so that would help.
You know, yeah, so much money to make it about the expenses that they have on it. You know?
And we all know how to interpret self-employed like that, right? So like when we get this stuff in, doesn't take that long. It, more than anything, it's, the buyers don't like giving it to you, you know, because they have to go to their accountant or they have to have all the stuff, but. I mean, we know how to read these tax returns like that in our hands, so it's super quick from our end. Couple, you know, super quick, you still have to go through the tax.
Once you
return.
have the information.
Right, an hour, or a couple hours, you know, it's same day still, but it's, you send them the checklist, how long does it take the buyer to get the stuff back, you know? Sometimes, I mean, typically they're not getting you the stuff back in 30 minutes, they can, it's all same day too, you know, but that's kind of where that.
So do you send a link and with like the checklist and then they just upload it, like
Yeah.
for your site?
Correct, we have an attachment, or we call our mortgage documentation checklist, it's just like PDF attachment that lists everything we need. And then we have a link that we have a secure portal for document upload.
I would say now, but as far as pre-qualifications goes, people are pushing it to like 56%, 49.9% of debt to income ratio because the market is so competitive. And that's something that like, if you're working with a loan officer like us, if you have someone, what happens, say I want to buy a $250,000 house, well, now you see yourself in an option $375,000 in 2 weeks, so that's where like I feel like, okay, look, I'll do this pre-qual for this property, but this doesn't necessarily mean that they qualify for another property at this price, right? Because we can go off last year's taxes, is it in the flood zone, is it in the HOA? So when you find yourself in that scenario, it's a little bit more communication because like we're pushing them as far as they can go. And we need to take a closer look at almost like each property individually. That's I've seen a lot more of that now.
So you would like this, you'd like to see the property, like, property?
I would tell you, I'd be like, hey, look, I could just like straight out qualifying at this amount of money, like max blanket. But if you want to look at properties that are more than this, you need to look at that actual property. Or I can say that can't be no flood zone, can't be an HOA, tax can be below this, but that's something that I've seen a lot more now because, there's nothing out there and people are spending.
People are spending more than they think and they're so close already to their cutoff.
They want to spend $1,200.
And then you get a $400 HOA.
Right, and then like condos for single family, like, a lot of, and I'm not talking about it anyway, a lot of online lenders, they'll say, oh, I got a pre-qualification for $250,000, but they don't differentiate condo versus single family. So if a condo has a $500 a month HOA or condo association dues versus, they were qualifying them off single family, but then they go and find a condo that they want to put an offer at $250. That has $500 a month.
It's like $100,000.
I mean, they're not gonna even be close, so like, that's why we always go over, what are you looking at, that type of stuff, and if they're wanting to push their debt to income to the limit. We gotta keep the agents up to date, like, hey, like they need to be outside of the flood zone, this is kind of where they're at, if you go above that, check with us on the property first, make sure. Flood zones, HOAs, that type of stuff, tell them check the house, total housing case, because that's what the ratios are based off, so it's just, it can be so different between two properties.
You guys provide a budget for 3 different price points, like, so if they're pre-approved, let's say 350. But they spend 275 versus they spend 3, versus they spend 350. How much their monthly budget is gonna be? I think a lot of buyers don't realize, oh, I'm approved up to 350, right? But then when they get closer to the closing, they're like, wow, this is how much it's gonna be. And they're like shell shocked.
So we go over the payment with them. I wouldn't say we like send free, because again, it's gonna be super property dependent. So like we'll go over, they say, I'm looking at 250. We'll go over the 250. Are you looking at flood zones? Are you looking at HOA? So we go over the payment with them, so they're not shocked, but we don't really give them 3 options.
Sure,
because-
no, I just an example.
But no, I mean, you're right. Someone said, I want a $300,000 house, and you go over the numbers, and a lot of times we'll go over payment with them. They're like, oh, but I also want to keep it in at $1,500.
Exactly.
You're
Like by
like,
the time you add in the homeowner's insurance and the flood insurance, anything else?
Well, even the
additional?
homeowners can vary so much here in Florida. with
Exactly.
the Age of the house,
so different, like,
1,200 or 3,800, whatever,
right, I mean, a couple years ago, you were getting new construction, like $600 or $700 a year, or buy off McGregor, an old house, wood frame, $4,500, like it's same price range, like. Now everything's kind of gone up, but like you were seeing a 3,000 square foot new construction a couple of years ago, for like $800 or $900 a year, that same house would have been off McGregor, wood frame would have been crazy, So,
If you want a rough number for the field, like I would say like every 10 grand, it's probably like $50.
I usually just calculate it myself.
So like if you're like, oh,
For them.
20 grand is like $100, so like just rough ballpark numbers off the top of your head. And closing costs are like 3%, kind of thing. Closing costs are 3 days.
If they're putting 20% down and it doesn't appraise, and like maybe they have more to cover than 20% down. But it's gotta be the 20% to avoid PMI.
Correct. So the way that works is, so let's say someone was buying a house for 300 and it appraised at 280, right? So the lender's gonna lend based off the appraisal. So if they don't want PMI, it's gonna be based off 280. So someone's gonna have to come up with the difference. So in this market time, the seller most likely. So the buyer, if they have an extra 20 grand, it's not gonna be 20 grand, because then it's gonna be 20% now, be based off 280 versus 300. So it'd probably be 19,000 something, but they're gonna essentially have to come up with the difference to not. So like if they didn't have that, you can still do a loan, because you can do a loan less than 20% down and have PMI. So, and that's where a lot of these appraisal gap, these offers with appraisal gaps that never coming in, because, if the house is upgraded and doesn't have comps, the chance it's not appraised, and then, someone's gonna have to come to the table with the difference. So.
Yeah. Question.
I don't know which one of you were gonna talk about the conditions of what FHA and VA is looking for on a property.
Got it.
I think
So
that's
we get-
something some of our agents need to know.
Okay, so here, you're not gonna answer, but the reality.
Well,
We
then
get-
when
we
they're
get-
listing it, they can know whether or not, they can kind of.
Yeah.
They.
If it's a safety concern, first of all, that's gonna be an issue no matter which property probably, if someone can get hurt. As far as that goes, if there's leaks, things like that, but we get questions all the time, is this going to be an issue? Like, hey, there's a garage that's been converted to a living area, or whatever it is, it's been unpermitted. Like, so the answer is, it really depends on who the appraiser is. Every appraiser. Is this one trying to save the world, or are they trying to, do I want to take a picture from this side of the room, or do I want to take a picture from that side of the room and look this way? You know what I'm saying? So like every single appraiser is different, but things that you can definitely look for are obviously leaks, or obviously broken windows, or obviously like, electrical outlets that have covers on them, smoke detectors on FHA loans. We've seen that in the past. You don't always see it. Like if they said that they smoke detector in the house, or they did a GFI switch in the bathroom. Again, who's the appraiser? Peeling paint on a home that is in the lead-based paint era could potentially be an issue, but it's just really, who is the appraiser? How far back do they want to stand before they take the photo? But safety concern is the big thing that they're looking.
Because the guidelines are pretty open. FHA kind of leaves it up to the appraisers. They're not, it's not like, there's not a checklist that the appraiser has to go by. It's pretty open-ended, even times that we've tried to fight them, because it's like, the repairs that they're requiring are like $50 repairs and they want to go and charge another $150 fee. It's like, come on, like you're basically making this transaction $150 more expensive for the buyer on a $75 fix. But it just depends on the appraiser. A lot of this stuff, our AMC kind of just, they say it's kind of appraiser discretion, because it's open-ended as far as what the actual guidelines are. So. I know it's not a great answer, but it's the truth, it's just kind of what we've seen.
So a couple of things on just like a heads up. On FHA appraisal, the appraiser has to be able to do that. So like if you're involved in the appraisal inspection, you need to make sure that they get in. Otherwise, if they say no attic access, then they're gonna have to come back out, because you have to look in the attic if you're an appraiser. If you have bare concrete floors with nothing on them, that's gonna be an issue. Because it has to be finished. Terrazzo is fine, but like bare concrete floors is definitely, gonna be an issue. Holes in the walls are gonna be an issue, appliances technically need to work, so that type of thing. But, other than that, holes in the soffit outside, there's stuff to get in it. Probably gonna want to get fixed for appraisal. Is it gonna be an issue? I don't know, but there's a good chance that it's, so anything like that, you probably want to try to handle it, because an appraiser does have to come back out. It's going to cost $200 to send them back up.
Just to get into another bedroom that they didn't see.
Yeah, correct. Yeah, right. That's good on man. There's actually only $100 bedrooms. There's 2 bedrooms.
You got a deal.
So there's one other thing I wanted to talk about, and we'll just open it up for any questions. So appraisal waivers, property inspection waivers, you guys might know them as property inspection waivers, appraisal waivers. Do you guys know what that is? Okay. So a lot of times I'll just briefly go over it. I know some, it might be redundant for some of you. So a lot of refinances will get property inspection waivers. You know, they had enough equity that they didn't have to get an appraisal. Fannie Freddie over the last couple of years have really opened that up on purchases where we're getting a ton of appraisal waivers, property inspection waivers on people that are putting 20% or more down. They're putting more than or less than 20% down. It's rare that I don't think on purchases, I don't think I've seen any of them. On refinance, we've seen some under 20% down, but over 20% down, we're probably seeing 50% or more get appraisal waiver, property inspection waiver. So what do you need to determine if you get an appraisal waiver? You have to have the whole file. So obviously you qualify someone, you also have to have property address, purchase price, down payment, all that type of stuff. Because if you don't have purchase price, the system's not going to know what you're rated at. So if someone's put an offer in at 500,000, I could run the appraisal waiver system at 500,000, but the seller counters at 520. You get an appraisal waiver at 500, but not at 520. So that's why it's the whole thing, because basically it's running through a computer program, kind of like Zillow, and Fannie and Freddie are determining that there's enough equity or there's enough, the files, it's not quite as risky. And it's been a really good way for a lot of agents that use us heck, anyone. It's not just us, it's Fannie and Freddie system, but I've been running these for a lot of agents that want to put in, either gaps or waive the appraisals, because it's a little extra work. You're not going to want to do it on 10 different properties, but if you find a property that you want to see if it gets an appraisal waiver, my client wants this property, but they have X amount of money, they can do it, they can waive their appraisal based off of that. So I've seen some agents do that. It's a little riskier, obviously, because it still has to go through underwriting to get that appraisal waiver. But I can say if I run it through the appraisal system and gets the appraisal waiver, I haven't seen it not get one. They're running through the same system, so unless I mess something up, it should be fine. So some agents have done that as far as kind of a tool to help with their own.
As opposed to a desktop appraisal.
Correct, desktop's completely different.
That's what I thought.
Right, that's completely different. An appraisal waivers, no one has to go out. Basically the lender is accepting that value as is, that you put in. And honestly, we're getting a lot of them. It's obviously I think they base it off a lot of factors, but someone's listing it for 200, someone's paying 250, or someone put an offer at 250. Obviously, the higher you pay, the less chance you're gonna have an appraisal. But I'd say it's probably over 50% our companies had last six months to a year. If someone's put 20% or more down, I'd say it's probably over 50%, even on purchases. So it's been a good number. So it's just speeds the process up too. You can literally get the loan closed 15, 20 days if you get an appraisal waiver, because that's the thing that's the slowest. Saves the buyer the appraisal fee, and then obviously saves any issues with the loan appraisal. So that's any questions on that as well?
New logo?
648. I think it's 647, 200. I don't know. I know it, but I think that's my guess.
Around, it's like 640. So it's high now. So, that's the new loan amount, rates are going up. Why not? That's what they're saying, they're gonna get 4 this year, so we'll see what happens.
Yeah, what's your predictions for interest rates?
Man, they shot up so much in the last month and a half that I'm like, I typically tell clients I don't want to predict, but after seeing these last month and a half, it's just been crazy. It's just up every single week. So not a fun conversation to have with clients that are looking but haven't, bought a house yet, because they could be 0.5% worse, just a month ago. It's pretty big payment difference, depending on the purchase price and all that. So
Don't the way prices go up, or if the rates go up high enough, the prices.
With these
Moving from right.
it's some part of these cash offers, it's like, yes, historically, I'd say yes. That's Andy's prediction, the third business partner that's not here. He's like, rates or prices have to come down. Rates have gone up so much in the last month. So I always be like, I'm always like, well, you have all these cash offers. I'm not sure that's gonna be the case, but that's his prediction.
Overall, yes.
He literally told me that 2 days ago, so I'll give you his prediction.
And there's definitely, like, at the end of the year, a lot of people, everyone's gonna, a lot of people are calling for, we're not there yet, it's still, that's going up a lot from there, so, so that's what a lot of people are saying, 4%.
I think Goldman said that yesterday they predict the Fed to raise rates 4% this year, so that's Goldman's prediction, so. I would guess they're probably right unless something crazy happens where they're not shut down or something. Because if that happens, I mean, all bets are off, you know, like when that happened, with COVID, rates were already starting to shoot up and then they just went straight down, you know, so, I mean, a lot of this is government intervention, so if they, you know, it could change if something serious happened, so.
And that's why you invest in our PAC, to keep lobbying at the federal and the state level for it, right?
Any questions?
Thanks for having us.
And so you guys all have your cards and stuff, so give them an opportunity to qualify your people. Thank you all.
There you go.
Hope to see you soon.
Everyone.
Hey, that was awesome.